Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Igor Lebovic of Kindly Care coming to us from San Francisco. How you doing, Igor?
Doing very well. Thank you for having me.
Yeah, thanks for being here today. So talk to us. What is Kindly Care?
Kindly Care is an elder care marketplace where families can hire caregivers for their elderly loved ones. We are an alternative to assisted living facilities, and we are probably also an alternative to just finding someone on the street or recommend it to you through friends and family, and then doing it yourself. We don't necessarily see ourselves as an alternative to traditional home care agencies because we feel that between us and them, we address different market segments. An agency will traditionally do a really, really good job in addressing any care needs, assuming that you can afford an agency. Oftentimes, those costs are just exorbitant. We have many families who used to pay $250,000 per year to an agency for 24/7 care, and they say they just can no longer do that, so they come to us. And so, we find that if you are looking for someone who can do a splendid job and you can afford it, then usually the agencies are a tremendous route for you. But if you're just a little bit more willing to do it yourself, then we can obviously be an alternative to other places like Craigslist or just friends and family referrals. And we do a comprehensive job of making sure that your caregiver is background checked, you've got a solid compliance framework in place, and you can pay someone legally and take care of all of the employment responsibilities, including paying taxes and these types of things. So it's a service layer on top of the marketplace that takes care of all of your employment liabilities as well.
Interesting. And how did you come up with this? What were you doing before starting the business?
Just before this business, I was a co-founder of another startup called AirPair. And prior to that, I was an SVP at About.com, which had purchased my previous company. So a little bit of first starting off as an entrepreneur, then going down the kind of like the corporate career ladder, and then also hopefully going up the career ladder, not going down. And going down that path, and then eventually going back to my entrepreneurial roots. And this is now my third startup.
Awesome. That's always fun. Where'd you come up with the idea, though? Is this a personal experience? Were you trying to find caregivers for some parents or relatives, or what?
Yeah, most people who end up in this industry have that sort of an experience where they try to do it themselves and it doesn't really quite work really, really well. It's probably also the reason why most of the people that I know who are providing this service are in later stages of their careers. In my specific case, about 20 years ago, I decided to leave my parents behind in Europe and move to the States. And obviously, it's been an incredibly net positive experience for me, but arguably, it was net negative for my family. I've missed most of the birthdays and other life events. And, as my parents are aging now, I'm just becoming more and more aware of just how I'm not around. So there's been this guilt. It's been there for a long time. It's only getting worse. And I'm finally at a stage at my career where I was able to just really lean back and just really envision what is the most, value adding way for me to spend the remainder of my career. And I just couldn't really come up with anything more meaningful than this.
Yeah, no, it's definitely, the guilt is a big factor. I've got aging parents too, and it's kind of like, there's four kids in my family, so it's kind of like, all right, who's going to be the one to take care of these guys?
It really should have been me. I'm the oldest, adult child, and I'm not. So that's the bummer.
Interesting. And so I guess you're taking the business model is you're taking a percent of the fees paid to the caregivers by families. Is that it?
That's correct. So we provide not just the initial sourcing, service, but we also run the payroll on a weekly basis. As a part of the initial engagement, we make sure that the caregiver is background checked and that we've obviously done the proper sourcing work. But on an ongoing basis, a family can at any time come to us and request a backup, or they can arrange changes in their needs or whatever happens to them. So we are frequently engaged on an ongoing basis to help out, not just with helping arrange certain accommodations or transportation to a hospital or to see a doctor, but also on an ongoing basis. Every single week we are sent details about the clock in and clock out times of those caregivers, and we are then also processing the payroll, withholding taxes, creating the estimated quarterly payments, and at the end of the year also creating the Schedule H and the year-end summary, which is then prepared for the client as a signature-ready set of paperwork that they just sign and submit, and that's it. They don't have to hire a CPA, and they don't have to worry about hiring any other service professionals to help them out with anything related to hiring their caregivers, which is kind of rare, because if you were to do everything yourself, you would be really working with several professionals in this area.
And I was going to ask, I think you've kind of already answered. I was going to ask how you keep people from going around you once they've made the match, right? And it's probably the payroll services and all that keeps them on the platform and keeps your commission, worthwhile to pay. Is that correct?
I think so, and I would imagine that there are probably two main retention mechanisms in place. One is the ongoing compliance that is really just necessary. Families are rightfully scared of their caregiver either quitting or being let go and then claiming or submitting a claim for unemployment insurance, which is just the standard thing to do. If you are someone's employee and you're living from hand to mouth and suddenly your paycheck doesn't arrive anymore, then rightfully so, as the employee, you should submit a claim for unemployment insurance. And as a family, you hopefully have done everything correctly and have been putting money into that fund. So that is the number one mechanism for the domestic employers being found out to not be complying as they should. And one of the main reasons why families are looking for a more structured way of hiring someone domestically. The second retention mechanism, I would hope, is just the ongoing good service that we provide in terms of being available 7 days a week for any type of emergencies or additional requests. And we do a lot of work with our families, and we hope to earn their loyalty doing that as well.
Yeah. Yeah. Is it a tough business? And I ask that because we've not used a service like yours, but we've used a couple different nanny services that are probably analogous, and they keep going out of business. and that could be just something with how they run their business. But we keep having to find new nanny marketplaces because the ones that we use are gone. But I don't know.
That's too bad. And going out of business is definitely a theme in elder care as well. We when we started in 2015, we raised our first round in 2015. We had an interesting competitive landscape, which has really changed quite dramatically since then. We had a company called Home Hero raise, I believe, $20 million in a Series A financing, and then and just prior to that, another company called Honor raised also, I believe, somewhere in the range of $20 million.
Oh, yeah.
And then another company also raised a significant amount of money called Home Team, and these were all some of the larger financings of that year, all happening in this industry. And I shouldn't say largest financings of that year. Obviously, there's financings happening all day, every day, and many of them are much larger than that. But for Series A, early stage, companies, sort of tech-enabled companies here in our tech industry, either in San Francisco or related tech hubs, it was pretty unheard of. It was all happening at the same time, and there was a lot of enthusiasm for our sector. And then, now in 2018, if you look back, Home Hero is shut down. Honor has had a couple of pivots. I'm not really super aware of what's going on over there. I think they might be doing well, but they've also changed their direction a few times. And you also hear all sorts of different things about home teams. So I think it is a challenging industry. I think you really just have to keep your head down and ignore all that noise and just focus on one thing, which at the end of the day is just finding the best possible caregivers. I think that's the one thing that we've always tried to focus on from the very beginning. And I think our formula is very simple. Just make sure that you can take as little money out of that relationship between the client and the caregiver and pass on as many of the benefits or as large of a share of the total available care budget over to the caregiver. And if you do the best possible job you can, then hopefully you'll do just enough to stay in business. And that's been working for us. So we have built our business from ground up to enable caregivers to make as much as possible out of the available care budget. And thankfully that's resulted in 160,000 caregivers applying for jobs on our platform.
Great. How many markets are you in?
We are in 8 states.
Okay.
So we started off in just in San Francisco, and eventually we expanded to all of California. Then we went to Texas, went to Nevada, Arizona, Florida, and now more recently also expanded it to New Jersey, New York, and Connecticut. Great.
Cool. It's exciting. All right. Well, let's talk about your fundraising. And, usually I go chronologically, but maybe I'll go reverse chronologically with you. You guys just completed your Series A, correct?
That's correct.
And it looks like that was about a little over 5 million.
Yeah, 5.4.
5.4. So actually, the reason I want to go reverse chronologically with you is, given what you just said, right? You had all these competitors, well-funded competitors, some of them pivoting or going out of business. Did that make it harder or easier to raise money? Like, how did that play into the fundraising?
That's a great question. And, what I can tell you is that raising our seed stage was probably too easy, and I probably have to attribute some of that seamlessness to just how hot our industry was at the time, although I can't really say so, because it's also possible that we just simply met the right people at the right time and just got lucky. So it's really hard to say that. And then the Series A was definitely more difficult, but I believe that the Series A is always more difficult for everybody, just because the focus is on the analytical side of things. And when I say difficult, it doesn't mean that somehow the conversations were difficult. It's just that the process was a lot more structured. And in our seed round, and I'm breaking your format a little bit because you did want me to focus on your Series A, but the contrast is pretty interesting for me. I remember very well for our seed round, walking into meetings thinking that the best I can ever expect is maybe to just get this person to get interested, and then maybe either introduce me to other people or start a conversation, and I actually walked out with a check. So and not proverbial check, more like a handshake with saying send your information and I'm in. And so that was mind-blowing. I had honestly I was surprised a few times. In fact, there's this one meeting with, this one investor who I'd known before, but I didn't think that this person would be the right. I didn't think that we were the right, match for his interests. And so I really just wanted introductions to other people, and he had me pitch him, and I pitched him, and he said, "Okay, I'm in." And the way he said that, and the way my expectations were sort of set for going into the meeting, I actually couldn't catch myself, and it was probably one of those really bad rookie mistakes that I did. I said, "Really?"
Uh-huh. Sure.
and he laughed, and then I laughed, realizing just what a dumbass I am.
It's
And then
good.
he said, I'm still in.
Yeah, I'm still in. That's
And I'm
funny.
like, okay, thank you. And then I was like, you don't thank an investor, you just make them feel that they just earned themselves an incredible amount of money.
Yeah.
So a lot of comedy and a lot of like, what seemed at the time as just like incredible luck, and maybe it wasn't, maybe it wasn't, but those types of meetings definitely were not happening at the Series A stage. It was a lot more, here's an email intro, then you meet in person, you meet with one person, and if they like you enough, then they introduce you to their data team, and then their data team asks for access to your data room, and then a week later you check in on each other, and they have some follow-up questions, and you meet again, and you meet one more time, and at that point maybe you're going to be pitching to the entire partnership, and then you pitch to the partnership and you're good. Now again, this was our experience. I can completely see other companies being maybe just so hot or growing so fast that there's this incredible FOMO, and where Series A meetings still get negotiated in a single meeting. It wasn't my experience, and so I would say that the Series A was interesting, not necessarily due to the competitive landscape. I'm not sure that I can really make that correlation very easily, but maybe as a contributing factor, maybe that was also a part of the conversation as well.
You can see how that would maybe scare people off too. It's like, okay, this business model is killed off 2 startups or one and whatever, 1.5, 2. Did it scare anyone off, or were they, pretty enthused that you're sort of this lead horse emerging from the noise?
Yeah, and before I even answer that, like, by no means am I, projecting that there's any more than just like one company that shut down. I mean, from what I understand,
Yeah.
everybody else in our industry is continuing to raise money and continuing to, do as well as before. There's just conflicting messaging
Yeah.
that confuses the market and confuses the investors. So to answer your question then, I'm certain that in some instances it actually helped that we had some of these conflicts happening in our industry, and I'm certain that in some other cases it actually hurt. The way it helped is because, the it's the same as like just basically assuming that there are fewer competitors.
Yeah.
Whatever your valuation was a year earlier, that somehow had to be tied to the size of the available opportunity, and assuming that you're splitting the addressable market by 3 or however many companies, then the size of the opportunity must be smaller. And as soon as somebody reorients themselves or focuses on another opportunity or does something different, or maybe like there's a difficult financing of another company that is pretty public and well known in your industry, how to leverage that to your advantage? Well, you would basically focus on the upside, which is fewer headwinds for you directly to address your consumers and help them out with their needs. But there's no hiding that the industry obviously has some challenges, and that you have to be very skilled in avoiding those. And hopefully in your pitching, you're going to very clearly elaborate what you think the challenges are and how you're going to avoid them. I think I've
Yeah.
done that correctly a few times, and I'm definitely I'm not aware of any times when I've done it very, very poorly, but I'm sure that it didn't help with every single investor.
Yeah. I probably more so in your industry. I mean, you're a marketplace, and most marketplaces tend to be winner takes all, or 2 winners or 3 winners take all, right? So,
Unless you're Airbnb.
yeah. All right. Let's go back and forth a little bit. And you don't have to tell me, but was the guy who said I'm in, was that Paige Craig?
No. This was
No.
from so I had never worked with Paige Craig before. Paige actually definitely required more than one phone call,
Oh.
and rightfully so. I mean, if I ever were to turn into an investor, I would find it very difficult to commit, at the very first meeting. And to give this other investor credit, I've actually known this investor for about 2 years leading up to that meeting. And we'd known each other really well. We had worked together in the previous startup. He was one of the first investors in the previous startup, and I had a direct reporting relationship to him because I was a co-founder. So I think for him, the question was not, who am I and what my skills and abilities are. For him, the question was more like, is this a type of an industry that I think there's an opportunity and that Igor is skilled or, a good match for that industry? And somehow those questions got resolved within that, 30-minute meeting. But nevertheless, not every meeting went like that. And I wouldn't expect any meeting to go like that unless you actually had a prior relationship like that.
And I think, maybe part of it's timing. If PitchBook is right, it shows that seed round was in April of 2015. And I think like spring of 2015 was kind of like one of the peaks of fundraising, right? You sort of had these little mini cycles. Our
timing was definitely right. I have absolutely no regrets when it comes down to timing. We were able to close both at the peak of the VC activity and at the peak of the investment activity in our industry. So it was really like, back to back. I mean, every month you will hear about like, something happening there. And we just simply started getting inbound interest just because of all of those headlines.
Yeah, that's great. Cool. Okay. So, and then I guess, did you do another seed in between, or kind of, was it more of a bridge round? I'm seeing like Floodgate, MHS, and a few others, Granite, in between. Is that correct or no?
Yeah, so we were, and this is something that I think happens quite a bit. You get an allocation for how much you can raise in a given round, and that allocation is, for the most part, driven just by your internal team's appetite for dilution. So let's say, you agree, and this are all hypothetical numbers, but let's say for like ease of calculation, let's say you're gonna raise $1 million on 10 posts. So that means that your pre is 9. And if you suddenly find a lot more inbound interest and people are willing to put in an additional $1 million, you're not only diluting because you are issuing an additional shares for that additional $1 million worth of capital, you're also diluting because your pre was pushed down now to 8. It used to be 9, and it got pushed down to 8. So you're diluting in 2 ways. Number one, you're taking on more capital and issuing more shares because of that. And number 2, you are actually also lowering your effective net valuation by taking on more capital. So we have, in each one of our instances, both in our seed stage and in our Series A, we have had more interest than we were able to find a location for. And so what we have continuously said to investors that we wanted to work with is, we can only take X of your money today. And if you are still willing to put in the additional money that you had actually offered, then I would like to come back to you 6 months later when I've hopefully doubled, the company and de-risked it further. And hopefully you and I can agree that, a higher valuation will be warranted at that stage. So that type of a, thought process has frequently happened, I believe, not only at Kind & Care, but also in other companies. And we've been able to save ourselves some dilution by splitting the rounds into more than one.
Interesting. I actually haven't heard that. I mean, I'm sure it happens all the time, but I haven't heard that as much of a strategy. But do you actually negotiate that sort of second little tranche and the valuation at the time of the first?
We didn't negotiate at the time. The money was available, and we were only able to take much less than that. Essentially, and this is very simple. You get 2 or 3 people who are competing to become the lead investor, and as the lead investor, you get the majority of the round and you dictate the terms.
Yeah,
and it's a difficult choice. Like, you just have to really go with your gut, and ideally you would work with everybody, because any one of these people will be incredibly value adding. And oftentimes it really just comes down to who commits the first. Other times it's about something else. Either way, you're faced with a decision of what to do because you'd like to work with more people, but you just can't really find the allocation for it. So what I've generally tried to do is to still get a chance to somehow take their money if possible, and carve out by saying, going to the investor who ends up being your lead investor and saying, would you be comfortable with putting in just a little bit of less? The benefits of getting this additional investor involved are twofold. Number one, we get their capital, which is great. It's always great to get people's capital. But number two, you also get their brain trust, and you also get their commitment to your company, because clearly they like the sector and they like what you're doing. And from your meetings with them, you develop some sort of a respect for them, and you'd like to have them on your team. So oftentimes you have that flexibility to go back to the previous investors who you've perhaps already gone pretty far down the path of negotiating the total amount of investment. And 5 minutes before 12, you basically go and ask them, look, somebody else became available. I'm not trying to take this away from you. You're still our lead investor. You'll still do the full deal. Can I just have maybe a little bit of your allocation dedicated to this new person, because I'd love to have them on our team. And then if you do well over the next 6 months and you develop this really great relationship with this new person, I think it's pretty natural for them to develop a desire to do more.
Yeah, interesting. Would you also say it's sort of like buying optionality on who might lead your next round, or are you thinking more brain trust?
It's actually, I would say the optionality is probably more on the investor side of the equation than on the founder side of the equation. If anything, you actually have a little bit of a liability there because of the signaling risk.
Yeah, right. So, at both the seed round and the Series A, how many investors do you think you pitched? What did the size and shape of your funnel look like?
At the seed stage, we got really lucky. We were able to raise our very first check, the check that we raised before that second meeting. That was so funny. That check came from someone where I had very little to show and very little to present, and then when I was able to just at least announce what exactly I was going to work on, I was given an opportunity to take a small check of $50,000, and that $50,000 went very far because that investor made a lot of introductions and really sort of gave that crucial initial momentum that allowed me to go and meet a lot more people and close those meetings. And those were very targeted meetings. We were able to really meet the right people and really just make a lot of progress in a short amount of time. With the Series A, so to give you numbers, I think I had about 10 meetings, and we closed 3 major institutional investors, 2 angels who I'd known before, and actually 3 angels who I'd known before. And I think we had one additional one from probably Paige, who I hadn't met before, but who also was an incredibly well-targeted meeting for me. And there were surprisingly few people who said no. I mean, we were at the right place at the right time. The meetings came from a trusted, source, and some of the people who had committed early, and they showed a lot of momentum, and there was a lot of confidence around the project early on. So that was really great. For the Series A, it was definitely a larger top of the funnel. If I were to go and really count every meeting that I took, I would probably go above 30, to be honest. It's really not something that I have at the back of my head, but I will tell you that the process definitely took longer. The process went from, I would say it took about a month.
That's not very long.
And if anything, yeah, and if anything, well, it took longer than the seed stage, but it was definitely on the shorter side of things, and that's because I had really great mentors who explained to me the value of sort of approaching it all at once and trying to find the right balance between practicing and warming up and being really good at what you do, which sort of that school of thought, is sort of optimizing towards stretching out the fundraising period over a long period of time so that you can, come up with the first version of your pitch deck, take a couple of meetings, come back, retrench, go back to your designer of your pitch deck, go back to your data analyst, go back to a couple of other people, and reformat what you have there. Look yourself at the mirror a couple of times, and pitch it a few more times, and really make sure that it all sits really well, and then go again, have a second wave, and have a third wave. And so that school of thought would tell you that you probably want to spend 2 or 3 months doing this. The other school of thought, and I have to credit actually a fellow entrepreneur who gave me this. He's running a very successful company, and he was he always found it very easy to raise, and I think that comes a little bit from his perspective. He said the Valley is such a small place. Everybody knows everybody. They get together all the time, and even when they're not getting together, they just proactively send emails and tell each other what they're looking at. So the chances of your investor in the 5th week of fundraising already having heard not only what you're pitching, but also who's already accepted and who's passed are very high, and usually it's not going to be flattering. If you're still fundraising in your 5th week, and by that time a lot of information has surfaced around your fundraising momentum, you are going to be suffering from that. So I was trying to play between those two extremes. The same entrepreneur actually suggested something pretty aggressive. He basically said, what you really want to do is you want to tell everybody a couple of months before you start fundraising that you're going to be fundraising. You set a specific date, and you create everything that needs to become available, including your pitch deck and your data room, and everything is good to go. And then you open up a 2-week due diligence period where on the same day you email your 10 or 20 or however many investors and let them know, here's your access to all of my data, and I'm available at any time. Call me, email me, or let's get together. And you just really have this hyper-focused approach of everybody having the same amount of time to review everything they need to review. And I think that works mostly well for companies that are incredibly hot, for companies that are a little bit more later stage, where the decisioning is mostly based on the metrics and not so much on the narrative. And also on founders who just have really strong relationships with these types of VCs, because you don't want to come across as a bit rude if you do that, where you're telling everybody, hey, you've got 2 weeks, I'm going to be closing on this date with or without you on board. That's not going to be a great start of a new relationship. You really want to do that when you're really comfortable in your skin as an entrepreneur raising this round. And so I tried to play in between. I tried to go for that 4-week period, and we stuck to our schedule.
I mean, I like the super compressed approach, because obviously less time spent fundraising, the better. But how do you get to know investors? I mean, you're entering a several year relationship with these guys and gals. So how do you get to know investors in such a short time frame and build trust, a relationship, and even just knowing who to pick? How, can you? It's like speed dating. You can't really pick your future wife in speed dating, right? I don't know.
Well, if you meet your wife at work and you've been colleagues for a couple of years, and then you enter into a speed dating session, then you know a lot more about each other. And so one thing that I was able to do with the person who ended up giving us the term sheet, Alex Gurovich from Javelin, the minute that Alex extended his term sheet, I basically stopped the fundraising process. And the reason why I did that is because I had met Alex not prior to starting Kindly Care, but very soon after our seed stage. I think Javelin had a social event, and they were inviting entrepreneurs to come and join them, and I think they'd either closed a fund or they've done something similar. And so I was able to meet Alex and introduce myself and tell him what I was doing, and he expressed interest in learning more. So after the social event, I came and met him in person, and we really spent quite a bit of time about learning about each other and learning about the business. And I made it very clear that I'm not disclosing any metrics, and I'm not disclosing anything that's not pertinent to just getting to know each other, and that I'm not fundraising, and this is not a pitch for funds. This is just the start of a relationship. that first meeting, I really don't really remember the exact month or the date, but I'm certain that it happened back in 2015.
Mm.
And so, him and I started building our relationship at a low frequency, but still, I basically, back in 2015, I would tell him what I was going to do. And then I did that. And then in 2016, we would catch up again, and I would tell him what I was going to do. And then I did that. And he established a bit of a comfort and confidence in seeing my track record over that period of time.
Yeah.
So when we were doing our Series A, I completely agree with you. There were people there who I'd met, and I walked out of those meetings, and I just really wouldn't be able to tell who these people were. Like deep inside of them, what their vision would be for our company and how they would react. It is a reputation business, and everybody has a reputation, and you can research that. But really, a reputation only becomes publicly known if you exceed a certain threshold in either being amazing or being horrible. And there's this broad range of behavior in the middle where that just stays within the four walls of you and your entrepreneurs, and you're not always going to be able to dig up everything. And so when we were in the final stages of our Series A, we had about a handful of people who were sending very strong signals that their term sheets were coming. In fact, one of them actually invited us to come and pitch to his partnership on Monday. But when Alex extended his term sheet, I just looked at the prospect of getting another term sheet on Monday and having yet somebody else who's potentially interested, which I could perhaps leverage for getting a better deal out of Alex or doing something else. And this may sound completely irresponsible, but I actually shook hands with Alex on Friday and said, this is it. I'm happy, and I want to start this relationship today.
Yeah. This is always an interesting one too, because kind of riffing on that a bit, like how much of the negotiation happens before the term sheet is extended versus afterwards, right? And that sometimes depends on the investor. It sounds like in your scenario, I mean, you sound happy. You sound like a pleased customer. So I guess it worked out. But I don't know. Any comments on that?
Yeah, I mean, look, it's always going to, change from one investor to another, and I think as an entrepreneur, you're also going to have a better poker face than some other entrepreneurs, and it's going to vary from one person to another. I think with Alex, it was pretty clear. He was very upfront about what was important to him and where he was negotiable. And I don't want to speak on his behalf and sort of position Javelin as a company that cares about this or that. So I'll let him actually publicly state what's important to him and what's not. But generally, you have a couple of levers you can pull and push on. One of them obviously is the valuation. The other one is the percentage of the ownership, and then you have some other ones where number of board seats or a couple of other things that you really care about. And I would say most investors that I got in touch with, they either saw themselves as going after huge opportunities and only investing those and being extremely selective about what company they would invest in. Meaning, like if your TAM wasn't large enough, they wouldn't put money into your company, even if it was a guaranteed positive return on their investment, just because they didn't have the time and didn't want to invest their time and their energy into something that's not going to potentially return the entire fund.
Yeah.
So usually those types of companies with larger funds or those types of partnerships with larger funds, they are a little bit more negotiable on the pre and post. Like I actually heard very specifically the guys who wanted to invest in us or had us pitch to their partnership on Monday, they said, we would like to give you a higher post or higher valuation. And so that's interesting and appealing if all you care about is this one aspect. But you kind of really touched on this earlier. I didn't have a relationship with this person before, and I was going to enter into this sort of marriage of sorts, and it was going to be sort of rushed a little bit, and I wasn't comfortable doing that, no matter how much, well, I wouldn't say no matter how much higher the valuation was, but it was going to be within a reasonable range, and it didn't really matter to me that much at that point. I had my well-known investor who I was really comfortable with, and they gave me a great deal, and I was willing to take it that day. The other lever you have obviously is the ownership aspect. And so, some of these larger funds, they may be willing to give you more money, but they also will still stick to 20% or 25% or 15 or whatever they're comfortable with. And so, you get a higher valuation, you also take a lot of money from them, but you're still, diluting yourself to a similar amount. And,
Yeah.
raising more money doesn't always mean a better outcome for the company. If you're dealing with a fund that needs a huge exit, they may not be comfortable with you taking 20% more money you raise from them and then putting it aside for the rainy day. Like, they may want to see you really going for it
Yeah.
and spending it all in the next 18 months. And these are all the types of considerations that an entrepreneur has to consider. Is your growth style aligned with the style of the fund that you're going to be working with?
Yeah, no, that's a good point. Is your growth? I think that makes sense. I don't think that's always obvious to founders who are talking to these big funds, that there's a certain growth style expectation. These bigger funds are going to want to put multiple rounds into the company probably, and have you burn it faster in some ways. So that's not always obvious. Jumping around a little bit, but like with Alex, you said you met him at an event 2015 and ended up funding you 3 years later. In between there, and you said it was kind of low frequency relationship. Were you sending him like a newsletter, or were you just occasionally chatting with him, having coffee? I guess the question is, what was the relationship building looking like in between those two?
The only touch points we had was when they were doing either a social event and I would come and visit, or him and I would cross paths one way or another. I did not pursue what you mentioned, which I've heard that it works really well for some people, which is go and see your X number of investors. Of that X number, only a subset will go and invest in your previous round. And then everybody who you met and you feel comfortable with and you want to keep in touch with, put them on a newsletter and give them a short and abbreviated version of your investor update that you send to your smaller set of your active investors. And so that's an intriguing proposition. The challenge there is, and I'm speaking very candidly here, the challenge there is that you are potentially, and this has nothing to do with Alex per se, just has to do with just the challenge on a global scale. Like, you either do it for everybody or you don't do it for everybody. That's the way I look at it. The challenge here is that imagine you've got like this group of like 20 or whatever many people who are getting you updates. You're never going to end up working with all of these people. At best, you're going to get a subset of these people actually working with you. And so you're sharing more information than you necessarily have to. And I do think that transparency is often helpful, and it can really be extremely beneficial for recruiting purposes and getting the PR going and everything. But I also do believe there's a kind of like a point of diminishing returns where transparency also removes options off the table. So one of the defining traits of a startup is that you have the ability to be flexible, and that you have the ability to also make changes if necessary. And to some extent, it's great to be transparent and to lay out a vision and to hit every one of your targets every single time. That really works in your favor when you do that. But if you miss any of those targets, then having this incredible paper trail becomes a little bit more of a liability in that case. So I think the way I try to approach it is a little bit more on a case-by-case basis, as opposed to having this very standardized outreach strategy of putting people on the same newsletter and sending them all the same information. I was updating people socially, and if anyone seem to be a more value-added investor than others, then I would be probably willing to share a little bit more than someone who all I always get when I communicate with them is just this a one-way conversation. There's this one person out there, actually, and I don't want to name them, but there's this one person out there who every time we met, and unfortunately we didn't end up working together, but every time we met, he added an incredible amount of value to me as an entrepreneur and also to us as a company, just because he's such a source of knowledge and such an incredibly insightful individual that you feel like the more you share, the more targeted and focused and valuable the feedback becomes. And so you almost are not only pitching your company for them to put money into you, but you're also learning in the process and collecting all the best practices. And so I was tailoring my level of transparency based on the value I was receiving in return.
That makes sense. Makes sense. One of the things I do, like with quarterly updates, is I'll have like start with the section like quarter in review or quarterly highlights, right? Which is what we did, and then end it with looking ahead, which is kind of like what are the cool things we're going to be working on this next quarter, and it sort of connects those dots of what you mentioned with Alex. Like you tell them what you're going to do, and then you did that, and sort of building this cycle of here's what's coming up, and then you're reporting on that. It seems to be pretty effective. Good stuff. Fuck. Let's see. One or two more questions, and I'll let you get back to it. Anything, if you went back and were doing this all over again, would you do anything differently, or other advice you would, give your younger self going through this process again?
That's a great question. What I definitely would have done differently is I would have recognized the value of designing your pitch deck. I prepared our data room and had it ready, and I assumed that people were going to take a lot of put a lot of focus into it, and I might have missed the importance of actually hiring a designer to help you also with the narrative. And so I'm not a designer, and I'm an engineer by training. So, my way of communicating a narrative is a little bit more factual than a designer would do that. So early on, just before I started, the actual outreach, I ran what we had in assets by my board, and basically, the feedback that I received was just that, look, it's correct and it's accurate, and you say all the right things. There's just a little bit of a delta between what we get pitched from other Series A companies and what you are pitching in terms of just the level of polish of the presentation.
Interesting.
And I never knew that it really mattered, to be honest to you. I really assumed that once you get to the Series A level, all that matters are the facts. But it makes sense that someone who is able to provide a higher level of polish is supposedly more detail oriented, knows how to pull off not just great metrics, but also takes pride in what they do, and it just really reflects on you in many different ways. So I think that's one item that I would have done differently from the beginning. The other item that I also learned fairly late in the Series A process is using DocSend, which I think is a bit controversial. I've since met a lot of people who are really split on this topic. So don't take my advice without really double checking with other people. But here's the idea. So DocSend is a service that allows you to upload your pitch deck onto that service. It's basically a cloud-based service, and it gives you a link that people can then use to access your doc. And it allows you to view not only who accessed it, but you can also lock it down so that only people with an email address, they have to provide an email address in order to proceed to the next step. And then when they proceed to the next step, you can lock it down so that the deck can be downloaded. So at most what people can do is take screenshots, which is probably not what everybody would end up doing. And then you track their behavior, and you're able to see how much time they spend on each one of the slides, and you see how often they come back, and you see all these details. And from the analytical point of view, once we implemented that in our process, it was really very value adding. I could tell which slides resonated with people and which ones didn't. Another thing that I kind of enjoy about this is that you can set an expiration date to that link. So when you finish your Series A, you can just simply take it away from people again. You can simply say, okay, well, my deck is no longer available for anyone to review it. I will come back in 2 or 3 years with a Series B deck, and then we'll talk again. And obviously this is very, very controversial. So, I might change my mind on this, but today, as a founder, not speaking as an investor, speaking as a founder, I value the flexibility of being able to, control the narrative.
Mm-hmm.
Um, I do think as a founder, there's some benefits to this approach. Obviously, there's some downsides. One of them is that some VCs may push back on this and ask you for something else, in which case, what I've done is I would follow up and just give them what they asked for. But it actually only happened once, and I don't think that it should happen too many times. I've heard VCs, not related to my approach here, but related to DocSend in general. They came up with a lot of points about how when they have continuous access to your information, they might come to you off cycle and just invest in you just because they thought of you and they have access to your information and they're able to check it out. And I think some of these points may be valid, but a lot of the points that are being used from the VC side of things are a little bit self-serving. And I think the net is that the founder is better served using a service like DocSend than just emailing your, PowerPoint presentation or whatever, or your PDF presentation or whatever you end up using to share your presentations.
Did you notice a correlation between folks who spent a lot of time looking at your docs and who came on and wrote a check or offered a term sheet? Or
Absolutely. Yeah, absolutely. The reason why I discovered the value in DocSend is that, it's almost like in a way it's a sales process. And so I've never actually run a professional sales team, but I've heard enough people talk about it that at this point it's kind of like almost like lead scoring. At the very early stage of your fundraising process, everybody's a lead, and maybe you're able to assign certain attributes to your leads, but at the very beginning you're not really sure where it's going to go. And so you may have too many people that you have as potential leads, and you want to focus your attention on those who are most likely to close. And DocSend becomes an incredible tool, not only for controlling access to the information, but also for evaluating the likelihood of anybody closing.
Yeah. And did you use an actual data room provider, or were you using DocSend as a data room? Like, did you have a data room?
No, we did not. We just used Dropbox. So we probably should have done a much better job in using something more professional, and that's probably an area where I can still improve a lot more.
All right, awesome. I'll let you get back to it. This has been great. Anything you want to plug? Any open job recs you want to talk about? Any deals for people looking for elder care? What do you got for us?
The only deal that I can offer to you is what we offer to everybody, which is we are the cost leader in elder care. You are not going to find a more affordable way to hiring someone legally with all of the services included as a part of that package. So, if you are so inclined, or if you need our services, check out kindlycare.com. We are kindlycare.com. We have some interesting ways of presenting our caregivers. I would encourage everybody to check out those profiles to see how we have put a lot of time and energy in just really vetting people and also getting them to a point where they're able to very accurately present their strengths, and where you also will be able to identify any weaknesses that some of these candidates may have, either in terms of communication skills or years of experience. One of the things that we offer is a video recording of every one of our caregivers. So yeah, kindlycare.com. Would love to see if anyone has any questions about the service. And in terms of open job opportunities, it's a moving target, obviously. So definitely keep an eye on our job board. But as of today, we are hiring a director of success, and always looking for just bright, talented, people across all areas. So if there's anything that you would like to do with us or for us, reach out to us. You can easily figure out my email address. I'll probably get it one way or another. And would love to connect with anyone who's passionate about this industry.
Any plans to move into nannies and childcare? It's I'm speaking selfishly here. Yeah.
No, it's a good question. As of right now, no, because I think it's one of our differentiators. I
Mm,
think a lot of services that do what we do also do many other things, and because of that, they end up finding, kind of like a good compromise across all of these different models. Just to give you an idea, our biggest competitor is called Care.com, and they do home cleanings and pet sitting and child care and elder
mm,
care, and I think they do something else as well. And as a result of that, all of these models are so different that what they had to settle on is a very it's a certain standard of customer service which I feel is inadequate for elder care. So
yeah, makes
when you
sense.
think about like how much responsiveness and how much availability you need when you're booking someone who's going to be cleaning your apartment, and what's the worst thing that can happen when somebody comes and cleans your apartment, that's not, I think, the same level of standard that you need for someone who's coming and looking after your mom.
Hmm.
So we invest very carefully against the criticality of our service, and I think you might almost be better off having a different company service a different segment. But I might walk back on this. I don't know. Maybe a couple of
Hmm.
years from now, we end up finding ways to combine more than just one model under the same roof. For now, we are very, very proud that we are focusing on elder care only, and we're optimizing everything against that one type of a service that we offer.
All right. Awesome, Igor. Thank you so much. And good luck with the business. And we'll catch you after the next round. How about that?
Thank you so much, Nathan. It was a pleasure talking to you.
Cheers. Bye.
Bye.